At the end of last week, it was still Groundhog Day in the crude oil futures market as the price was sitting at around the $40 per barrel level on the nearby NYMEX futures contract. Groundhog Day was a movie starring Bill Murray in 1993, where every day turned out to be the same. Yogi Berra, the Hall of Fame Yankee catcher and armchair philosopher, said, "It's déjà vu all over again." Since early June, crude oil has been sitting around $40 per barrel after recovering from its first negative price in history in late April. Commodities can be one of the most volatile asset classes. Over the long term, the oil futures market tends to move slowly and steadily during rallies and becomes a falling knife when the price drops. The most dramatic example came in 2008 during the global financial crisis. As the monthly chart illustrates, nearby NYMEX crude oil fell from a record high of $147 in July 2008 to a low of $32 per barrel in December 2008. The drop of 78% in only 5 months is an example of an elevator shaft path of the energy commodity during bear market periods. The last example of the price carnage that has become typical in the oil futures arena came this year as futures fell from $65 in January to a record low of -$40 per barrel in April, a decline of $105 per barrel. Crude oil will not remain at $40 per barrel forever. The market will either get back on the staircase and make a higher high above $44 on November futures, or an event will trigger another elevator shaft journey to the downside. Two issues face the crude oil market over the coming weeks. The first is the November 3 election in the US that could substantially shift energy policy. The US is the world's leading crude oil producer. A sweeping victory by Democrats could cause US output to decline. The election is a referendum on the future of the US role in the oil and gas markets. The other issue is the continuing threat of COVID-19. Futures shutdowns would weigh on energy demand and the price of the energy commodity. Moreover, it tends to be the unknown that causes the most substantial moves. The Middle East remains a part of the world that can trigger significant price volatility. While it seems like ages ago, the rally to $65 in January resulted from tensions in the region that is home to over half the world's oil reserves. Crude oil has become a tightly coiled spring at the $40 per barrel level. The longer the spring coils, the more dramatic the eventual move. Any risk positions in crude oil require tight stops, as we could see volatility return to the market in a blink of an eye.